All right, stock started the day before the market even opened to the downside, but as it has been the case for most of this past few weeks, we've just rallied up to the upside by the close, and that's how it was. We didn't finish with an up day on the S&P, but we at least closed above the open, so we're still in that positive direction. The question not is whether it's does it have momentum, does it have breadth, is it trending to the positive direction, or is it just grinding its way kind of to a stop as it heads towards resistance? Or have we broken resistance enough to be able to feel like we're not going to hit this resistance? So all those things I'm going to break down today in today's video. We'll take a look at what's driving the price action as usual, looking at different asset classes, sector performance, and how they're moving here. Kind of some interesting pattern on the sector rotation on long-term basis. So we'll break that down. And then we'll take a look at our trade idea of the day, of a stock that's been kind of grinding itself. We'll talk about how to trade that. And as always, our goal is to get our YouTube channel up to 10,000 subscribers. We know that most of you that are watching the video we see are not subscribers, so help us get to that goal. Just click that red subscribe button down there below. Hit the thumbs up while you're down there as well, and we can get to that magic 10,000 mark for us. With that, let's go ahead and get started. Today is Wednesday, April the 19th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that we do at the end of the market trading session on the days I do the Market Outlook here. Come down here, click on this heart. It opens up this tab. Hit that like button that pops up there. Also click on the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, the more you click on these, it really helps us get all of our content out to all of our followers on those platforms. We dipped a little bit below, almost got to 100 there. Let's see if we can. Our goal is always to be above 100 on these as much as we can. There's obviously it's like thousands of views on this, so on this tweet. So if we can get that above 100, that'd be great. The more comments, shares, likes, that goes a long way. So thank you to those who do that. That's why we ask for it every day. And for those who don't, you can do right now with one or two really easy clicks while you're watching. All right, let's get started taking a look at the S&P 500 with the market forecast indicator. Another open candle. This one's red. All the rest of them are black, of course, but that doesn't necessarily mean that it's not that bullish of a candle. It's actually relatively bullish. You can see you tend to get some of them down here at the lows. You got one over here at a high point, got a couple of them actually, over here at the high point. That was a pretty small one. You had one over here as well. So they can occur during bullish moves. They tend to occur more, though, kind of here at the lows more frequently than they do up here at the highs. It does mean that the bears are around, right? Because the bears were around. They just were around in the pre-market more so than during the day. You can see because of that, the momentum line continued down. It was a small range today, too. Again, another small range. The near-term line, again, turned down without, it's not getting into the upper reversal zone. And despite that, your intermediate line is like as extremely high as it's ever been here without the near-term line getting very much into the reversal zone. But the issue and the reason why it's so high is because the near-term line is not dropping either. You can see it's kind of very similar to this move where you had the near-term line stay up. It dropped below 50, didn't get in the bearish territory for a long time until over here it finally got into bearish territory. That's kind of what we're getting right now. The near-term line's been out of bearish territory for a long time, multiple weeks now. This one, of course, without the momentum line itself getting into the overbought zone, we did have one spike there on the momentum line getting up there. We haven't had that yet. This is about as big of a spike as we've gotten here. Really, really early on, you had that move higher. Again, not a 2% move, but you had that move higher that got you to the 70th percentile. So close, but not quite above the 80th and into that zone. And it's definitely not above 90, which is kind of where you really like to see these early moves that start the intermediate runs. You like to see them get to. Of course, over here you got above 5% above the 30-day moving average, and so far we The highest we've gotten is 3.7%. We can't quite get above that 4% mark above the 30-day moving average. So we're just kind of grinding our way higher here on the S&P 500, and you see a very similar pattern across other indexes like your Dow Jones Industrial Average, which now has the near-term line falling out of bullish territory and the momentum line further into bearish territory. The intermediate line, though, still extreme highs, as you've had, 3 out of 4 days now to the downside and 4 out of 6 to the downside on the Dow Jones Industrial Average. Your NASDAQ's been less bullish than the Dow. It's been really sideways and kind of down since March 31st. So this entire month, for an example, the Dow Jones Industrial Average, here's where it was on March 31st. So you can see we're actually, quite a bit higher on the Dow Jones. You look at the S&P 500, and you can see where we were on March 31st right there. So we're a little bit higher than where we were there. But your NASDAQ is actually a little bit lower than where we were on March 31st. So it's been weaker lately, and that hasn't kept the intermediate line from getting into to extreme highs above the 90th percentile. But you can also see the near-term line for the NASDAQ has dropped down out of bearish territory already. The momentum line, though, at least avoiding bearish levels for now. And then finally, the Russell 2000, setting up a little bit of a divergent peak. You can see you're getting lower highs here on the near-term line and relatively higher highs on the index itself. Another bear tag. And still kind of not able to follow through with the bear tags with more days to the upside, right? You get the bear tags, you follow through, you turn into dark green shading green line. You get the bear tag, you follow through, you get the more dark green shading green line. You get the bear tag, you follow through, you get dark green shading the green line. You get a bear tag and you can't follow through, you get another bear tag and you can't follow through, and you just can't get going, and you end up not getting the intermediate, the dark green shading the green line. And that's kind of what we're seeing here is we're getting multiple bear tags, and neither one of these we're able to actually follow through with more moves to the upside. The intermediate line has crossed out of bearish territory. It's pointed higher. It's not at extreme highs like the others, but at least it's above market sentiment, which is actually the worst out of all of them. Market sentiment's in bearish territory here for the Russell 2000, and we still got the light green shading and the yellow line with, like I said, that divergence on the near-term line. So, we're still kind of getting, this kind of pattern, like we saw. The intermediate line actually did get into bullish territory here during that run, and we actually did get, 4.5% above the 30-day moving average there, and here we're only 1.5%. So you can see how we're kind of struggling to get going here. Let's take a look at the weekly chart for the S&P 500, and you can see a slightly higher high, 4163 to 4169. So we've hit that mark. We have a higher close as of right now. Of course, remember we're trading. The midpoint next week will be at 4119 as of right now. We're trading at 4154. So you can kind of see it's actually a pretty bullish weekly candle. It's good. That's a good sign. So we're still at this resistance. You can see we're not above that Fibonacci level yet. So we're still there, but and your green line's still below the purple for now. You can kind of see same thing happen over here. You actually did get another bullish candle after the green line crossed below. You got another pretty decent bullish candle, and it stayed below before the reversal. And so you're still potentially at that reversal, especially considering you're at resistance. The resistance there being the moving average, the resistance here being multiple exponential or multiple Fibonacci lines here at this point that we're not quite getting above yet. So that's what the weekly chart looks like. Let's take a look at the 3 green arrows. And you remember, we still have 3 green arrows. The MACD hasn't turned red yet on SPY. It hasn't turned red yet on the diamonds, as close as it is. And your stochastic's nowhere near a red arrow. So you still got easily 3 green arrows there. We do not have 3 green arrows in the Qs. We still remember we're down since March 31st, which is when pretty much all the rest of these. The Qs turned green a lot earlier on March 16th, and the S&P turned green on March 29th, 2 weeks later. So that's why you're a little ahead of schedule. but you're off the 3 green arrow mark. Your stochastics is in the reversal zone. You're still well above the 30-day moving average. So it's really just the MACD that's giving you the red arrow there. And then your Russell is fluctuating, right? It's fluctuating between red and green and red and green. It can't get multiple days, right? Which again, you get that bear tag, which is the day you cross the moving average. Essentially, the day you get this green arrow on the moving average. You get that bear tag, you need to stay above and keep the 3 green arrows. And as I mentioned, the Russell has been unable to do that, which again suggests that we're probably going to be unable to get the kind of move we want to see out of the Russell. Your S&P, you can see it's still hanging around there. The MACD is as flat as it can be. I mean, that is about as flat as you can be on the MACD. It actually is slightly negative here on the PPO. Remember, the MACD is not normalized for a price. The PPO is. But it's similar, and the PPO has just been flat, not really going anywhere. You're still easily above the 8-day moving average, but for there to be no momentum, suggests that you're kind of grinding away here. You can see some of these other oscillators like the DMI. You're well below 20 on the negative indicator, and you're still falling on the positive and not really getting above 30 and getting strong enough that you can get this ADX up above 20 yet. So that's an issue for the S&P 500. You look at some of the other oscillators, you're still above 60 easily, but you're forming a bearish divergence on the CCI as of right now. At least they're still at bullish levels, so that's in our favor. The Ichimoku cloud is barely, but it is above the levels that you need to establish an intermediate trend strength, above 2, above 65 down at the bottom. So at least you have that going for you. You have a very strong rate of change over the last 26 days. You switch to a weekly chart and you can see again, we still don't have a bullish. We're 6 months in, so that's 26 weeks. You can see the 26-week rate of change is pretty positive. So we have a pretty decent 6-month return coming off the lows and no trend develop. Again, the only other time we've seen a no trend develop, I'll have to go a little bit further than this. The only other time we've seen a correction like this, a 6-month move off a correction or bear market low for that matter, and not get a trend develop after that 6 month was right here. Right, we were 6 months coming off of from September to March in 02. We couldn't get a bullish trend going at all. We got up to the cloud. We had a pretty decent return. I mean, we had a pretty decent, not strong, but it was a positive rate of change. And then we just hit resistance and rolled over. That's the only other time that we've had, we haven't been able to at least establish a week, even just a week bullish trend. We are above 0, but we're not anywhere near being above 50 right now on that trend strength on the weekly chart. If you look at the Bollinger Bands relative to the Keltner channel, you can see you're still below the Keltner channel. So again, you're not in the upper quartile of the bandwidth. You're not above the Keltner channel. You are in your momentum is stagnant here, and this is the kind of moves you get. Slow grinding moves that are typical of a convergence period that you're going to get as soon as that MACD drops below the moving average. You'll get that convergence period there as long as the S&P stays above its moving averages, as so far it has been doing. You can see a kind of a significant drop on the McClellan oscillator after getting to 27, so below 35 yesterday. It stayed down, even got lower at 19.5. So whatever breadth, whatever semi-strong, really only semi-strong breadth we had, we're now losing the strength of that breadth as we're dropping below, and as long as we stay above 0, that's okay. But we don't have the momentum, right? The strength we have to keep us going to the upside. That goes along with the new highs and new lows as well. Right here. Here's your new highs and new lows, which are still above the minus 100, but they're not above 0. I mean, we can't be bullish, a really strong bullish move, without the breadth being above 0. In this case, the new highs and new lows being above 0. Over here at the August peak, it finally got above 0, and then we failed. And over here, it easily got above 0 during this peak that finished with that February exhaustion peak. But here we are again at similar levels, and we can't get anywhere near 300, or what did we get up to? 375 on the day that we got that exhaustion gap on the S&P 500 on February 2nd. So we're still lacking a lot of the breadth, even if the volume has been relatively decent from a money flow standpoint. Your money flow has peaked here. Before that peak has been relatively bullish. Now there has been, after it gets to these levels, you have had at least little pullbacks to the moving average there, and then over here after this peak, anytime you get above 70, which is not very common, but when you get above 70, you tend to get at least a little bit of a pullback, and you wonder, at least a near-term decline on the market forecast. You wonder if that may be the case now, as we've really peaked at a relatively high level here on the money flow, even though the money flow itself is not peaking itself or breaking up to new highs and getting where we need it to get to. You can see the range. We are still towards the top of the range. The moving average for the range has gotten up above. I've shown you what it looks like in a bearish trend. This is what it looks like in a bullish trend. So here in the bearish trend, the orange line gets above 80, and that kind of signals our decline, our stops. But you can see in a bullish trend, it can be above 80 for quite a while. And you get little pullbacks, but you just bounce right back up above, and you can stay up here for quite a while, up in these levels. You can see over here as well, and over here too. So this is less common to get these kind of peaks, but it's kind of typical of the kind of market we're in. Of course, the factor that really kind of determines this is how long we're going to be at the top of this 4-week range. And as of right now, we got a new high yesterday. We filled in this gap from this morning, so we don't have to worry about that. We got a new high yesterday. The new low is over there. So we're not any threat. The new low has hit zero. The lows, has hit zero in the 4-week range. But the green line hasn't dropped below 70 yet, and that's really what you need to concern. You would ideally like to, on a bullish expansion, get this, that Bollinger Bandwidth to move up higher. Which means you have to get outside the Keltner channel. You would ideally like to get this line to move up to a strong level. You can see even on this August move, you got above 10% on the gap in the 4-week range. Over here on this November rally to the upside, you got above the 10% gap. You did not in December, and then now this move is even lower than that, right? This move, the peak is at 7.5%. This one, at least you got it to 9.5. So the problem is on each successive rally, the width of the 4-week range is getting progressively smaller, and you can see unless we get a new high point here that really extends up, it's going to get even smaller in the next few days, early part of next week, as the low point moves up here, and then up here, and then up here. In a matter of 1, 2, 3, 4 days, your low point is going to be right where my cursor is. Essentially, the low point for last week, which is where the brown lines are, last week's high and low. There's not much difference between the high and low of this week and the high and low, which is the Good Friday week, the high and low coming after Good Friday, and the high and low, the high at least so far this week, right? We've had 3 straight weeks here, and Friday of the week before, where we've gone perfectly sideways. So we kind of need to break out really strongly in one direction or the other to get this range to move up. The problem with breaking out to the upside is we're in a convergence period right now, which limits the upside moves on the broader market and opens us up to be more susceptible to the lows moving up faster than the highs can move up, and bringing this range down to extremely low levels, like we saw here before a breakdown to the downside, and here before we had a breakdown to the downside, and over here before we had a breakdown to the downside. And you get my point, right? And then over here as well, far left, before we had a breakdown to the downside. The part of the reason why, our VIX is really, really low. The VIX has dropped down to 82% of the VXV, the 3-month VIX. That's a big dramatic drop here. What did we end up getting down to? We got down to 82.25%. The lowest level the past year, or the lowest close, we're at 16.5, which we haven't closed like even in early January. The lowest close we had over here was 16.6. So this is the lowest close since before Thanksgiving, when this whole thing started. At least on the Russell, it started on Thanksgiving Friday. That's where the correction started, and then of course it picked up on the S&P after that peak on January 3rd this calendar year. So we're below that, even though we're not down to the 80% mark. That's for this past year. That's an extreme low, and relative to the VX to the volatility of the VIX, the VVIX has not dropped down to that low level. As you can see, that correlation over there. The VVIX jumped up. We've had 2 straight days of the volatility of the VIX spiking to the upside. That's not like completely abnormal for a 2-day move. If I were to look at the rate of change just for 2 days here, hit OK, and then change this to a daily chart, and then just go VVIX here. You can see that that's not the biggest 2-day move we've seen, but it is one of the bigger moves. Only that one on the financial crisis was bigger. You had 2 days there where we kind of gapped up February 9th before dropping back down. You had a 2-day move there, and then this one here in late September, you had a pretty big jump in volatility. So it's not the biggest move, but to have the VVIX drop as much as it has, and bringing the correlation down to well below zero, down to minus 0.33. You can see the last 2 times we've had the correlation, the 2-week correlation for the VVIX and the VIX be this negative. We had that jump in volatility coming off the August peak, and we had eventually that jump in volatility going into February expiration, and then with the financial crisis, right, we had that trend higher. So I don't know if we'll get a financial, I don't know what the catalyst will be for volatility to move higher, but generally speaking, when the correlation between the VIX and the VVIX gets this negative, it generally leads. You can see another one, that there's the August peak over there. If I were to go out to 2 years, it's not very common to get these levels, but if I were to go out to 2 years, you can see another one right there where the correlation in April of 21 got this low, and we had that rally in volatility. This is the VIX up here, and then over here you had one that was also more than 33%. So I have to go to 33 now here. But to be as low as we are right now, we had this one, that spike in volatility, and this one that led to, in October 2020, that led to that spike in volatility. So when you consider how extremely low volatility is relative to the VVIX, right, with that big jump in the VVIX over the past couple of days, and then you look at how extremely low the VIX is relative to its own average values. In this case, the average value, let's see, I need to come down here, relative to its 200-day simple moving average. Here we go. You can see, like, that's extreme. I mean, it's not the lowest of the past year, but it's in the half a percentile, half a 1 percentile. It is near the lowest. There's only been one other instance of it being lower in the past year, and in the past 5 years, you can see it's in this below the 2nd percentile. So we are, for the past couple of years, as far below the 200. Remember, as I mentioned to you before, when the stochastics hits extremes, it's not very common for the stochastic itself to hit zero, essentially. I mean, single digits. But when it essentially hits zero, and the moving average especially hits zero, you can see that has also led to a rally in volatility there, a rally in volatility here, and a rally in volatility here. Some of these also including the correlation between the VIX and the VVIX being well below zero itself. So there's a lot of stars lining up, including the seasonality of the VIX heading into the sell in May and go away period. But you can see if I go out to the full 20 years here, This is a time frame right here where we tend to bottom on VIX. Now we don't necessarily bounce straight up, but we don't go very much lower anymore. And again, considering how extremely low we already are, you don't expect that we will go much lower than this. Maybe closer to 15, maybe even dip our toe below 15. But even the seasonality, take out the patriotic volatility dip around the July 4th holiday. I mean, this is a time where we tend to bottom, and then we end up peaking by the end of October. Sell in May and go away until the end of October with only one little dip there in July. From a seasonal perspective, that gives you that break in what is generally a gradual rise in volatility over the 6-month period. And we're a lot lower now at 28%. In fact, we're lower now at minus 28% year to date. We're twice as low now year to date as we were up year to date when we peaked during the seasonal bullish time of year for the VIX. So while the VIX isn't seasonally expected to spike here, it is seasonally expected not to go down anymore. And considering how extremely low we are, on the VIX, that would suggest, especially when you move this much, this fast, that would suggest that you are going to spike. I mean, the VIX, the VVIX itself has moved down so much, or moved up so much over 2 days to kind of give you an idea of how much the VIX has dropped. If you were to take a look at like a weekly chart here, this over the past few weeks, 1, 2, 3, 4, 5 weeks here, and give you a sense of just how much we've declined, how much the VIX has declined over this past 5 weeks. You can kind of see where my cursor is. This is, we've dropped 35% in 5 weeks. You can see, some other instances here and here where we've dropped about that much over here as well. And you can see the rally over the next so many weeks here, here, and here, coming off those extreme lows, and over here even as well, coming off of that low in November, where we eventually ended up peaking at 53% gain in volatility over 5 weeks. The most of that gain was after 1 week. See this low point over here eventually led to a 5-week 54% rally in volatility. This one led to eventually a 60% rally in volatility over the course of a 5-week period. So here we are again, minus 35%. Again, considering how extremely low it is with all the other things I've shown you, even this would suggest that we are, due over the course of however many weeks, a pretty decent move up to the upside in volatility. And of course, what would that mean for the equity market when you are, I didn't show you the whole, where you are converging here, you're remaining below that 20-day hull. You're well past the 20-day mark for this without it turning red, and you can see how close the parabolics are and how close we are to crossing below the moving average here at really a much lower peak for the MS, for how far above the 200-day hull we are during that peak and that peak, right? And even the August peak, this would be by far the lowest peak of being above the 200-day hull, which would make you wonder. I mean, we got lower here than we did on this instance, so we're getting kind of slightly lower highs, slightly lower lows, and now we're getting easily a lower high. Does that mean now we'll get a lower low than that point, which means a little bit bigger move below the 200-day hull than what we've seen here for a while? All right, now let's take a look at what's driving a lot of the price action here today. Again, very minimal day. You can see the S&P flat, but in the Qs, and IWM up a little bit. But you can see the bigger movers today were commodities coming down. Now, granted, remember, commodities had been rallying here. In fact, if I were to go back, let's go back to the beginning of this whole rally we've had. So starting on the 23rd of March, where we've been on this consecutive day streak without a 1% decline here. So let's go back to that asset class comparison chart. Here we go. And we'll start on March 23rd. Going forward. Here, let's go to like an hourly chart. So here's that how things have performed. And again, you can see why commodities fell, because since the S&P has been rallying more than both the Qs and IWM, for that matter. You can see they're both at 4%, and the S&P has kind of been diverging a little bit away from them, especially in the last week or so. You can see that commodities have been a big winner as well. Bonds have been rising, but you can see now bonds are falling at their lowest levels. So bonds are actually down 2%, which means yields are up. Commodity prices are way up, and the dollar is relatively flat, down to flat, with the gold prices rising initially and then coming down themselves. You can also see emerging markets kind of matching what the Qs and the IWM have been doing as well. I told you from March 31st on, that's when everything peaked, and then the Qs are down from that period. So if I were to go here, let's go one more day from the 31st. We'll just go here to April the 1st. So you can see the Qs are actually down. IWM is flat. The S&P is up 1% since that March 31st. So again, you can see the grind higher. Gold and commodities benefiting from the relative weakness in the dollar, and you can see bonds are down during this time frame. So bonds have had kind of a little bit of a move here lately, dropping back below the 30-day moving average, staying below the 30 and the 50-day moving average, as well as the point of control, the 200-day. A little bit of a fake out move to the upside before working its way to the downside. The dollar is kind of similar, just in a different direction. You can see the dollar was moving lower, has been rallying here over the last little bit. Back, trying to figure out whether it's actually going to move higher and get above the 17-day moving average, with the MACD already above its moving average and rising, and stochastics too above its moving average and rising. So you can see we're a little bit of a convergence period for the dollar to actually move higher, and of course that's in the past has weighed this equity markets have not preferred the dollar to move higher. But when you have yields moving up as much as they are, and you can see the odds of a rate hike, as we talked about, being as high as they are, up to 86%, then your dollar is going to move on these higher rate hike odds. And that's what we're seeing with this dollar reaction. That one of the biggest moves today actually occurred in Bitcoin. Again, Bitcoin represents the kind of far end of the risk appetite spectrum. Has been in convergence mode for quite a while. The histogram peaked. Remember, usually the histogram peaks, then the actual MACD peaks, then you start your convergence period. So we had our histogram peak, then the MACD peak, then we got our convergence period with the red arrow on the MACD. So really we've been converging this for a few weeks now, as we stayed above the 8-day moving average, much less the 17. But now you can see we're starting to flirt with breaking below the 17 and cause a little bit of potentially a bearish divergent pattern. Again, this is on the high end of the risk appetite scale. Again, kind of the similar end of where ARK Investments has been. ARK Investments have made such a big, strong rally. Has been going pretty much nowhere since then, sitting right on that point of control as the market's wary about sending, these quote-unquote long duration stocks so far to the upside right now. Now let's take a look at how the sector moves, how the sectors have been performing here. Today first, and then we'll take a look at some of those other time frames that we talked about previously. So you can see just today alone, utilities and real estate were your big winners. Not typical, right? That's not your typical move. But let's go back to March 23rd, since this 8-day run started, 18-day run started, or however long it's been now. Again, you can see utilities and real estate are your biggest winners during this time frame. It's not, a risk appetite move. And you can see even you have, again, during this whole 18, however many days it's been, technology, discretionary, communication services all lagging, industrials lagging, staples, of course, lagging. You can see financials were lagging. They were one of the biggest problems for the weakness early in March and before a little bit of a run here during earnings season for most of the stocks in that sector. But the fact that we were so bullish, 5.5% over this period, And utilities and real estate have been the biggest winners pretty much for most of this entire period, including energy. Again, goes to show that this is not the strongest leadership, and I wanted to bring that up here on the relative rotation graph. When you look at the long-term charts, you can see safety trades are dropping and cyclical trades moving up. Technology, communication services, and discretionary moving up here, up to the right, or at least moving straight up, not necessarily too much to the right. You can see here that after some strong outperformance over multiple years on XLK relative to the S&P 500, you can see after peaking, we've really dropped in the momentum. We've been gaining some momentum as the relative strength is now moving up. But you notice again that relative strength is not up very far, or did not go down very far relative to the gain. And this is usually a oscillating kind of a chart, so it usually comes down about as much as it goes up. If I were to go back to say, as far back as we can go back here. It looks like we go back to 1999, but you can see how the RRG performed originally, because the tech bubble burst and technology was such a big drop, and since then it's been oscillating from about the same levels up to the same levels down, and vice versa. And now we really went up on this parabolic move into early 2021, and since then has been dropping. But that, with the rise in yields, that's putting pressure on these kinds of stocks, and you can see it starting to move up a little bit here. But if you go, let's just take a look at what's kind of going on right now in a lot of these areas, and you can see financials, which have been beaten up so badly during the financial mess that we were in, really moving over up to the right, and you can see technology, discretionary, communication services moving down to the left. In fact, looking at the weekly version, we've already seen XLK, XLY, XLC make that run up and to the right, and now they appear to be running out of gas. And you can see real estate, energy, staples here, and utilities are also starting to move up to the right. So we're getting a little bit of a shift back, from what has been a pretty strong bullish sentiment for these cyclical areas. We're starting to shift towards areas like utilities and real estate. You could look at XLU here, and then go to a weekly chart, so you can see, it's been downtrending for so long, but you can now see that we're starting to move up a little bit. We had some relative strength over the course of 2022. We faltered. Now we have positive momentum. It's starting to bring the relative strength line up with it, as well as the relative strength line that you can see here relative to its moving average. All right, now let's take a look at our trade idea. And you can see as most of the market's been going so sideways, so has the stocks. Autodesk has been pretty darn flat over the past couple of expiration cycles, really coming from its last earnings announcement back in February, post-February expiration, and then it's been doing nothing since. It's been down. It's, you had dark pink shading and a red line for most, the red line for most of this period. The intermediate line still below its market sentiment. The near-term line can't really get going. We've had a bear tag, haven't been able to follow suit with it. But you also notice that we can't really get a trend going either. If you look at ADSK here, you can see again we were briefly bullish, 1 week of a golden shadow before turning right back down the earnings announcement and now staying below there. But again, we're not getting a lower close, we're not getting a lower low, so it's relative. You can see we're not getting a significant move. In fact, where you can see we're centered right on the point of control, the one volume node that the stock has for the entire year, essentially. And it's a big one, a big volume node, but we're sitting right in the middle of it, right on we're below the 200-day moving average, or below all these other moving averages, but there's no trend strength going on. You can see the trend strength is minimal. There's nothing down there. The DMI, both lines are below 25. As you can see, they're both really, really low. The Bollinger bandwidth is really low. You can see it's nowhere near getting out of the Keltner channels. and we're trading, we were trading a little bit more towards the midpoint, but we're still trading, right, we're not in the lowest quartile as low as that bandwidth is, and you can see all the red dots there because we're still stuck. The bandwidth itself is still stuck inside the Keltner channel. So what we decided to do for this trade, and this one we could not get through because my internet went down before the market closed, is to sell the 210, buy the 215, come over here, sell the 185, buy the 180. We have to do 2 of these. Excuse me, no, we're going to do it on the weekly chart. Sorry, that's why we did that. We're going to do this on the weekly chart, so that we can go $5 wide on both sides. We'll see where we ultimately get filled in here on a $5 wide spread. Getting at least $1.20 is the ideal scenario. Let's analyze this trade, and you can see I already have that on. The $10 wide spread on there, so let's get rid of this one there and just do here, and you can see a full position size, so we don't have to worry about earnings till after May expiration, and then the return that we're getting there depending upon where ultimately we get filled in. And you can see with the break-evens here, our break-evens are pretty much right outside that bandwidth, so it would take a pretty significant move in either direction, and really both lines are sitting around the value area. So as long as we stay stuck in the middle, this is perfect for this type of trade. Again, depending upon ultimately where we get filled in for this. We'll send that through and see where it gets filled in tomorrow morning. All right, well, that does it for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. Again, thank you very much for watching. Subscribe to our YouTube channel or click that thumbs up icon, comment on the video, follow and like us on Twitter and Facebook. Join our website at marketscholars.com for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.